Okay, so once again, we are looking at chapter 3. So here we learned in chapter 2 what a debit and credit is, and we understand what the accounts are, right? We have 5 types of accounts, and we've broken down each account type by category, right? And we finally understand how the normal balance comes into play. Now, this is where we understand transactions. So we're going to be looking at first off the chart of accounts, and then we're going to dive right into transaction analysis. So first things first is, what is a chart of accounts? It's literally a list of every single account that exists in your business, all right? And here's the number one thing that you should also know. The accountant is responsible to create the chart of accounts, okay? Now, as you can see, here's an example right here of a chart of accounts, right? You got every single account name with their respective account types. And again, if you use account numbers, it does help in some aspects, but in some businesses, they may or may not use it. You're not obligated to use it unless you find it useful. Okay. Now, with this though, let's take a look at our chart of accounts. So every single account that we see here, right? Notice this. It will always be in the order of account types, okay? And then again, it gets reordered or organized by the account category, and then so on and so forth. So as far as this, it's not based on account numbers, because one rule or one thing is, if it's useful, then you'll have your account numbers. But then you can always add to your chart of accounts at any given time. So therefore, the numbers may not reflect what you want to reflect, because if you're constantly updating or making changes or adding new accounts, then you can expect your numbers to, kind of go all over the place. You're never going to ever get the chart of accounts right from the get-go, okay? There's always going to be a justification, or adjustments or modifications, that's what I was trying to say, to your chart of accounts, okay? So that means here, let's take a look. It's going to be based off of the account type. So in the order as is, it's going to be your assets first, then your liabilities, then your equity, then your revenues, and then lastly, your expenses will come last. Okay, so just exactly like this example here, I have my assets lined up at the very top, then my liabilities, my equity account, my revenue, and lastly my expense accounts. And they're going to be in order also based on the category, which we talked about, based on, right? For assets, it's going to be how easily it's converted into cash. Your liabilities are going to be how long you're having for. And then equity has no accounts. And your revenue is going to be based on your operations. And then lastly, your expense is going to be cost of goods sold first, and then operating and non-operating. So that is going to be what your chart of accounts is. And the most important thing is, you need to have the chart of accounts in order for you to be able to journalize. So that the accountant must provide you the chart of accounts first thing first. And then the next thing is, you're going to properly journalize it using the debit and credit system and applying them to their specific accounts. And we're going to take a look at that and how to journalize our transactions. So once again, what is a chart of accounts? It is a list of every single account that exists in your business. Now, let's also take a look at this too. Not every single business will have the same exact chart of accounts, right? For this one, this is mainly towards maybe like a small selling operations, right? Maybe I sell coffee, maybe I sell clothing, right? So in this case, every company's chart of accounts will always look different, because it just, it's specialized towards what you need in the company in order to organize your transactions. So when we take a look at a transaction and we decide to sort the information to its specific accounts, that's where you're going to need your chart of accounts to recognize, do you have an account that exists, and does it fit there, and how are you going to apply it to it? Okay, so important thing is that you always need to have your chart of accounts. And for this entire class, I will always provide you a chart of accounts. I will not have you create one at all. Okay, so now we have that. Now I'm going to go ahead and introduce you to the journal. So of course the journal is going to look just like this. You're going to have 5 columns, right? You have the date in one column, you have the description in the middle, and then on the right side you'll have 3 columns. Your PR, which is your post reference, and then you'll either have a debit or a credit. Now this is exactly why accounting uses your debits and the credits as left and right, because just exactly how we see it in this form, it's exactly how we associate it, right? It's either you debit it on the left side or you credit it on the right side. So this is where we get the debit and credit system. Okay, so by understanding that core idea, right, let's start on, first off, what is a general journal? It's going to be a book or a record for you to record all the business transactions. Okay, now there's going to be multiple books, of course, because every position is responsible for a particular aspect of the business, right? You'll have one for sales, you'll have one for inventory, one for expenses, one for HR, So with that being said, for this class, since we are not compartmentalizing, we're not going to do, oh, you're the sales representative, you're responsible for inventory. No, we're going to look at this as an overall entity. As in this book, you're only going to be looking at one book and one book only, and that's just the general journal, and that's it. There's only one book, and that book is going to entail every single business transaction that you will encounter and that you will record. All right, so again, when you do move on to either getting a job at another company, you may have multiple books that you may have to enter transactions in. Okay, but for this one, we're only focusing on one. All right, now the first rule of thumb here is you always want to start with the date, because always when you're dealing with a transaction, the first thing you got to do is that you have to place every transaction in chronological order. Meaning that if the day it happened, that's the day you record it in the book. Now, oftentimes, what happens is that usually you'll go on with your whole entire day, you'll collect all the receipts, and at the end of the day, you'll record it. That's completely fine. You don't need to carry the book around wherever you are, and right when that business transaction has happened, you don't need to record it right then and there. Okay? So, again, most cases, you do it at the end of the day. Now, the most important thing here is that it has to be in chronological order. If you skip around, which is not good, okay, let's say you journalize for January, and then you journalize for January 5th, and then you missed a journal entry and decided to just throw in one and just place the date there for January 3rd. No, that's not how it works in here. All right, so it has to be in chronological order, and if you miss one, then that's where at the end of this you have to enter in a journal entry for a missing journal entry. Okay, you're gonna have to write in the notes that a missing transaction that happened on this date. All right, but in this case it has to be in chronological order. Okay, very important. Then the next rule here is how you actually write in your journals. first rule of thumb is, let's look at the description. Notice this. You have the account names, right? And notice, why is one left aligned and the other is indented? Reason being is because there is a rule that you have to follow when it comes to journalizing an entry. A best way to kind of recognize a journal without having to look very close up and read it itself is to recognize that anything that's left aligned is going to automatically be associated with a debit. Okay? While if it's indented, that's how you know for sure that it's a credit. Okay? To kind of tell you that just by looking at this transaction, right? Looking at the first one, right? I have one equal credit or debit, and I have the equal and opposite credit right here. Okay? Down below, right, I have a rent expense and a prepaid rent. I know that these two are my debits, and they equivalent to my grand total of $1,500, and I have my equal and opposite credit, which is my checking account. By noting that this is true, right, I can immediately associate that I have a debit and I have a credit. All right, just by looking at my journal. If they're all left aligned, then I'm going to associate that they're all supposed to be debits. Okay, so this is just a little technique just to ensure that you follow through with the double entry system. All right, that you have a credit and you have a debit. That's all that little details is there for. Okay. Now, again, for practice purposes only, if you're not used to it, that's completely fine. If you have everything left aligned, just make sure that when you do that, make sure that you understand which one's a debit and which one's a credit. So again, I will not fault you for that if you have everything left aligned. Okay. Now, the another most important thing that you want to know too is that, why is my accounts under the description? Well, usually that's what the journal's for. It's so that you can organize your ideas and place them in the proper accounts that the transaction is associated with, right? So in the very first one, right, we made a purchase of furniture. And how did we pay for it? We paid it in cash. So that's exactly what this transaction on January 1st tells me, is that I made a purchase of furniture. Here's what I'm going to enter in. I increased my assets, right? I acquired furniture. But by doing so, I had to decrease my asset because I had to spend cash. All right? That is how I can understand this transaction right here. Now, if I were to just write only the account numbers, do I know what I bought? Do I know when? Do I know how much I bought? What I bought? No. So that's where the description is going to come into play, right? The description right here, it always has to be in parentheses, and you can fill up and you can fill in as much information as you want. I could say I purchased furniture at a shop, okay? Or for a shop, okay? I could be specific. Which shop did I go to? I went to IKEA, okay? Or even more specific, I bought a couch from IKEA, right? So the rule of thumb here that I'm trying to get away with is that you have free range on whatever you want to write in the description as long as it's in parentheses. Most cases, a lot of scenarios, they either italicize it. I don't care. As long as you have the parentheses on it, you're good to go. And it doesn't matter where you align it. It could be centered, could be left aligned. As long as you have the parentheses, that's all that matters. Okay? And your description could be as descriptive as you like to describe the transaction that happened at hand. All right? Because oftentimes, you're not the only person that's looking at your books. You have the accountant that's looking at the books. You have the president that's looking at the books. Maybe the asset manager that looks at the books, and they want to make sure, what kind of furniture did you even buy? Where did you buy it? How did you pay for it, right? So that's exactly where the more descriptive you are, the better understanding the transaction can be. And even if you look at your books way back, right? If let's say you're responsible for this book, if I pull this transaction a year later, right? And I look at that, am I gonna know what I bought? It just says I bought furniture. Do I know where I bought it? It just says for a shop. So in this case, the more descriptive I am, the better that not only you know the transaction, other people will understand the transaction. So again, as long as it's in parentheses, that's all you need. Okay? So now I'm going to go ahead and move into the post-reference column. The post-reference column, so if you use account numbers, that's where you're going to place the account number here. So again, for example, my checking, right, is 10,100. If I go ahead and look at my chart of accounts real quick up here, it matches my chart of accounts right here. I have checking for account number 10100, and that's exactly where my post reference is going to line up with. Okay, now that is only if you use the chart of accounts and you use account numbers. Again, if you don't have account numbers, then you can leave the post reference blank. Okay. Again, it's kind of a way to double confirm that you placed the account or the debits and credits in the correct account and correct account number. But again, once again, you're not obligated to have an account number. Okay. All right. Lastly, rule of thumb here is your debits must always match your credits at the end of each journal transaction. Right? If it doesn't, then you made a mistake somewhere, right? Or you added wrong, or you made a fat fingered something, right? We're all human, okay? So again, the general rule of thumb is once you complete a transaction, you must check to make sure that your debits equal your credits at all times before you can move on. And that is how you create a journal entry, all right? Any questions?
No.
Okay. All right. So in this kind of sense, we have to always journalize our debit first and then debit our credits last. Okay. In exactly like this kind of manner. Okay. So that's how we journalize the journal. Okay. So let's go ahead and talk about transaction analysis. So this is definitely a page that you definitely want to save or print out, right? I don't remember what page it is in the notes, but it's definitely something you want to keep in hand, especially because this is ultimately what you're going to be practicing the entire time. And we're going to take a look at this when we go through every single chapter of the accounting, as well as what to do when we are looking at our fictitious business, our class project. Okay, here are the 7 steps in order to just understand a transaction and determine whether we need to record it in a book or not. Okay, so the first one is you need to collect that source document. That source document could be anything like a receipt, an invoice, a contract, anything that gives you proof of a transaction. And you need to be able to recognize that a transaction has even occurred. All right? So again, receipts, invoices, contracts, all of those are going to be considered a source document. And it's also going to be a proof of a transaction. Now, any transaction can happen, right? I could go buy shoes, that's my personal, right? Or I can buy a machine for the business, right? Those are all going to be considered transactions. However, now I need to determine whether this transaction affects my company or not. Okay? So again, that is what step number 2 is. Understanding, does this transaction affect my business or does it not? Okay, and whether it needs to be recorded in a formal book. Okay, so once again, step number 2 is If I collected the receipts, I need to determine how does this transaction affect my business? And if it does, then do I need to record it? Okay, so most commonly, right, you understand that I bought a machine. So for sure, that is definitely going to go towards my company. So once we deal with that, now for number 3 is we got to determine which accounts are affected. If I bought a machine, what is that considered? Equipment, good. So I acquired an asset. How did I pay for it? Right?
Cash or a loan.
You could do cash. You can do a financing program. You could use it on a credit card. There's multiple ways, right? As long as you have the proof of a transaction on your receipt. So if I said I paid it with a credit card, so in that case, I've determined what accounts will be affected. Now, once I've determined that, I have to go, number 4, go to my business chart of accounts to see if there is an existing account for that. So do I have an account for equipment, and do I have a business credit card account? Most cases, those are generic accounts that you should have regardless of any kind of company you are. So yes, I'm going to check my business chart of accounts, and if I don't have it, I'm going to have to request my accountant to add that account, or to tell me which account should I place this transaction in, right? If they say, oh, your equipment's going to be under fixed assets, there is no equipment under there. It's just fixed assets. Okay. So once you've determined that you found those accounts in your chart of accounts, that's where now you're going to have to determine how to use the debit and credit idea. So again, we got to use the accounting model. Okay? So step number 5, right? If I acquired an asset, right? Therefore, I increased my asset. So therefore, I need to use a debit. Okay? But I place it on a business credit card. Now, is a business credit card money that I own? No. It's money I technically, temporarily borrowed, right? That means I owe a credit card company. So in this case, it's a liability, a temporary liability, because they're not going to let you owe it for that long. They're most likely going to have you either do a monthly payment, or they may, most rule of thumb, you want to try to pay off a business credit card as soon as possible. So you have either 30 days upon that transaction to pay back the money. So in this case, I increase the liability, so therefore I need to use a credit. Boom, there you go. I have a perfect debit and an equal and opposite credit. So now, once I've done step 5, I've determined how to use my debit and credit system. Now I have to determine which journal I should use. And in this case, we only have one, okay, which is the general journal. All right. I'm not going to require you to know the other books, but in case you do have it, make sure you're in the correct book that you want to journalize this transaction in. In this case, we only have one, which is the general journal. And then lastly, step number 7, just like Nike's logo, do it. Okay? So go ahead and record that transaction. All right? So these 7 steps are going to be very, very crucial for you guys for the next entire end of the program, okay? For the next 15 weeks. Now 14. But so that means this is definitely something that you want to print out, make a copy, stick it in front of your computer or window, whatever it is, right? Because this is what you're going to be using every single day for the rest of this accounting term. All right? So once again, understanding how a transaction affects a business, understanding how to use the chart of accounts, utilizing the debit credit system, and lastly, just journalizing it. Okay? All right. Any questions here?
No.
Okay. All right. So now we're going to talk about correcting entries. Okay? I'm missing something in here. Okay. Anyways, so generate. Anyways, so correcting entries. Okay? So again, this is for you guys just because I understand this is your first time or we're going to pretend this is your first time journalizing in any journal book in general. You guys are going to be making a lot of common mistakes, errors, etc., etc. Now this applies to, like, if you're writing it down on a piece of paper, you absolutely cannot scratch out, remove, white out. You can't do any of those, okay? You can't even take a pen and just scratch it out. You can't do any of those because that's going to be considered a potential threat of fraud, okay? Right? If you try to wipe out a transaction as if it never existed, that's an opportunity for you that you're deleting a transaction and pretending it's like it's never happened. So, of course, we're going to be focusing on using Excel, which, of course, we have the friendly delete button. You can, if you made any spelling errors, you can always go back and fix it. But the general rule of thumb is that most cases you should not mess with those kind of journals, okay? Once you write a transaction, that means that's it. It's permanent. You cannot fix it. However, because again, this is your first time doing your journal entries, I'm going to allow you to make all the mistakes that you need, okay? If you've already written out, just reverse and start all over again, okay? And just type it in correctly, okay? However, when you go into the professional field, you absolutely cannot do that. Especially if you're dealing with someone else's business transactions, because you don't want to pose or make it look like they have fraud, okay? Because you'll get in trouble, the whole company will get in trouble, and it's all because you decided to just delete that transaction, okay? So again, rule of thumb here is you should never edit a transaction for any reason because it will look like fraud. So in order to correct those types of errors, we have two different types of correcting errors. We have the reverse and re-entry, okay, which is pretty straightforward, right? We find the error in our journal. We reverse the transaction, right, making it zero again, or as if the transaction, you're refunding, and then you're going to rewrite it in there again with the correct amount. So the best way I can understand to fully understand the reverse and the re-entry is that if I purchase items, right? Essentially, in order to reverse the items, I go back to the store and return them. And then I go back and purchase them for the correct amount. Okay? That's the best way I can to describe the reverse and the re-entry. Right? Now, the second one is going to be the error cancellation. Now, the error cancellation, it only requires one journal entry, and what you're going to do is you're going to look at the mistake that you made in the journal entry, and you're going to find a way to find the difference and journalize the difference in its correct journal entry. Now, I'm going to tell you this right now. Most often cases, if you don't really know what you're doing, you may write the error cancellation. You might make an error on the error cancellation, and you're going to have to redo the whole thing. So this is a tricky one, and it's mostly commonly not used because you need to know a lot about accounting. You need to understand what the transaction is asking. But secondly, the best widely known to be used is going to be the reverse and the re-entry because it's a safer route, right? You're reversing the entry and then you're re-entering it for the correct amount. This one is more widely used because you're more likely to make less mistakes from this. Where in the error cancellation, you're more likely to make more mistakes upon the original mistake that you've had before. So you might, you might enter in a journal transaction that may, um, you know, result in a bigger problem. Okay, so you might enter in the wrong account once again. Okay, so let's go ahead and take a look at each example here. So here I have an example. You went to the store on September 15th and you purchased office supplies with cash, okay, in the amount of $65 even, okay? However, okay, and sales taxes included already, okay? And then you end up going home and you record this transaction in your book, but in this time I wrote it as $56, right? So in this case, maybe I was tired and I didn't take the receipt out of my pocket and I just kind of guesstimated. All right, I wrote that it's $56 instead of 65. Okay, now I journalized it exactly like this. Okay, now let's say a couple days later I find this mistake. Let's go ahead and reverse this entry and then re-enter it. So in order for me to reverse this entry and place it into the correct amount, how would I do that? Okay, so if my original right now is I debited my office supplies for $56 and I credited my account, my cash account, by $56, how do I reverse this transaction?
Well, I know first you would record the date that you're doing it. You said
Mm-hmm.
so you're doing it a couple days later, so say 17 September.
Okay.
Um, hmm.
I'm not actually sure that I understand the debit, credit, and cash portion of this. Why you would, if you debit it, you're gonna use the $56 or $65 to buy the supplies. But then why would we? Oh, because that's showing the account that it's coming out of.
Now, I have a question.
Sure. I wasn't quite sure. I wasn't following along. Yes, Alan?
I was just going to say, could you put office supplies and then put the $9 in your debit,
Okay.
the difference?
Now remember, we're doing the reverse and re-entry. Now the
Okay.
$9 difference is going to be, we're going to look at that when we do the error cancellation. So
Okay.
you're stepping a little too far ahead. I'm
Okay.
asking you to reverse the entry. So in this case, I made a purchase of office supplies, right? I use cash. So this is my journal transaction right here, right? I used cash, so I credit my cash account and I obtained or I acquired office supplies, which is considered an asset, right? On my receipt, it says that I bought it for $65. However, because of due to human error, I recorded it for 56, right? 65 and 56, right? Maybe I fat fingered it. I did it too quick. 56 and
So would
65 are too close to each other. So in this case, I recognize I made an error.
So you have to put it back in.
So
so would we
yes,
do the credit for $56
to which account?
to,
Cash.
to the cash account?
All right, not okay. So in this case,
No, to
right?
the 1601 to the account on top of it for expenses.
Okay, so it's not an expense account. All right, so again, to fully understand this, right? I went to the store. I bought $65 worth of office supplies, right? But in
No,
this case,
I understand the scenario, but would we credit the account that the original $56 came out of?
yes. So in
Yes,
this
you have to put it
case,
back.
you would have to put it back. Exactly. So let's say, so again, I was in the middle of explaining this part. So if I went to the store and bought these office supplies, and my idea is I'm trying to reverse the transaction, I'm going to go back to the store. I'm going to refund it. So what should I be getting back?
Oh,
$56.
You should be
$56.
correct. And what are you getting back? You're getting cash back, right?
Mm-hmm.
Yes.
All right, so if I get cash back for $56, therefore, what's my opposite? What am I returning?
Office supplies.
You're returning your office supplies. Okay, so good, right? So we have that. Now we have to understand we need to also buy back those supplies for the correct amount. So if I were to buy back my supplies, right? But this time, instead of $56, I'm going to credit it, or I'm going to debit it for the correct amount of 65. So in this case, I'm going to reverse my transaction. So I'm going to gain back my money. I'm going to return in the office supplies while I'm returning, right? And then now the re-entry portion is that I'm going to buy back my supplies with the cash for the correct amount. So in this case, I'm going to re-debit my office supplies and I'm going to re-credit my cash, but this time for the correct amount of 65. This is how you fix a mistake that you made in your journal. Okay? So again, this is all coming towards of making mistakes in general. Okay? Because you guys are like, this isn't pointing directly to you guys, but this is a common mistake that all accountants do, right? If it's their first time, they don't really understand how the debit credit system works, so they just practice, right? So in this case, I recognize I made a mistake because I pulled out the receipt and was like, oh my gosh, I debited my account for the wrong amount. I put 56 instead of 65. Now, because of that rule that we mentioned before, right? You can't delete a transaction or edit the transaction for any means. Okay? Of course, with technology, it's simple, right? But in this case, I can't do that. So here I'm teaching you how to fix that mistake. So essentially, how I'm going to fix it is I'm going to return the item and then I'm going to buy it back and record it for the correct amount. That's how I fix my $56 and turn it back into 65. Okay? Is this making a little more clear sense now?
Oh yeah.
It does. It just has a lot of steps. Yeah.
Yes. So that's why I said this is definitely something, a rule of thumb that you need to know because you guys are going to be doing journalizing for your first time. You definitely need to know this because when you go out into the real world, you can't just go back and fix anything. It's a no-no. You have to take these extra steps in order for you to properly fix your mistake. And that's the error of it. Okay? So, again, yes.
Would this be like immediate? Let's say I just typed it in, and like a second later, I'm like, oh, I missed the cent. You got to do this whole process, or is this just like a day later, or is there a time limit on when you can go back when you input the information?
Okay? So, once again, because if you're typing it in, for the sake of this class, I'm going to let you make all those mistakes and I'm going to let you fix it right then and there. This is for when you go out into the real world. So, is there a time limit? Absolutely not, because if you find it right there and you fat fingered it, you can just go ahead and fix it. Right? Just like my errors, right? I typed in a few things. You guys corrected me on it. I can fix it right then and there because I have the technology. Okay? So that's also one of the pluses and minuses because again, we're looking at this as if you were back in the day writing everything, right? But in this kind of sense, you're able to edit and modify as you please. But again, most cases, if your company is very strict on you making those changes, right? So for example, when we dive into QuickBooks, you type in an error, you might not be able to go back and fix it. You're going to have to request the accountant's permission in order to go back and fix the transaction or have the accountant fix it for you. So that's what I mean by that. Is that, is there a time limit? Sometimes you might not even be able to fix it. What if this was a locked worksheet? And every time you enter something in, it's permanent. How are you going to fix it then?
Do the reverse, the re-entry right then and there.
You have to do the reverse and the re-entry right then and there. So yes. So there are a lot of rules and guidelines, especially when you go out into the real world. Okay. So does this make sense?
Yes.
Okay. Now, that's just one way of fixing the errors. The other way is going to be the error cancellation, as Mr. Allen was speaking earlier. We recognize, okay, we have a $9 difference, right? 65 minus 56 is $9. But in this case, when I look at this difference, I have to be very careful and understand which account am I short $9 for. Okay? So in this case, I journalized that I have $56, right? In order to fix this, am I over my assets or am I under my assets? Okay? Did I purchase less or did I purchase more? That's the question that you have to understand. And in this case, I'm short $9 um, in my office supplies, right? I'm also short $9 in my cash, right? If I walked into the store and I had $60 in my pocket, right? I go out and buy the stuff, or I'm sorry, I had $70 since I had 65. I had $70, right? I went to go buy the store, and then I look at my pocket once again. I only have $5. Where did my other $9 go? That's also one of the ways that you can find out where your mistake is, as, oh, I am short $9. So therefore, in order to increase each account, right? If I'm short by $9 difference, therefore, if my account is reflecting at 56, I need it to reflect as 65. So therefore, I need to add $9 more to that account, and I also need to subtract $9 more from my cash because I don't have the difference. I don't have whatever 5 plus 9 is, $14. I don't have $14 in my pocket. I only have 5. So in this case, right, that's how you can understand that. But this is also one of the dangerous things about doing the error cancellations, because if you don't really micro manage or micro, what do you call it? Like micro or dissect this transaction into very small pieces. What if I said, oh, 56 is my office supplies, right? I have 65. The difference is $9. Okay, I'm going to debit my cash for $9 and I'm going to credit my office supplies by $9. Right there, you're saying that you purchased less than $56 of office supplies. In fact, you actually gained more money out of it instead of the reverse around. So that's the danger of using the error cancellation, is if you're really not truly understanding the transaction at hand, you're better off using the reverse and reentry. Okay? And that's why it's more commonly used, because again, believe it or not, sometimes the older we get, we can't do simple math. We can't figure out what the difference between 56 and 65 is, right? We literally have to either punch it on a calculator or we have to manually write it on a piece of paper to determine that $9 difference, okay? So this does a lot of extra brain power. So if it works best in your favor, then by all means, use it, right? So Alan wants to use this one, he can use this one, okay? All right? So those are the two different types of fixing errors when it comes to journalizing. Right? All right, T accounts. T accounts are pretty, I guess straightforward, kind of, not really, not. I'm not going to require you to know this, but what T accounts are is it pretty much, again, if our journal is only going to reflect our daily transactions, right? What I can do on the side of the journal is, what if I need to make a quick, account balance? What if I'm spending too much money and I don't know what my account balance is? That's where I can go on the side of the paper and just write down, okay, if I started with this amount, I deposited this amount in there, but I wrote a check out for my rent deposit or my rent expense, and I spent $65 for my office supplies. Therefore, I should have a total of the $471. or $4,713, right? Because I started off with 5,124. I added this sales, I subtracted my rent, and I subtracted my office supplies. So therefore, I should have a count of $4,713 left in my bank account. So that's just a quick tally up. You can use it if you'd like. It's not something I'm going to require you for because we have the next greatest thing, which is your general ledger. Okay? So what is a general ledger? A general ledger is essentially another book that allows you to record every single account in your chart of accounts with their respective account balances. So let's notice this. Here's my cash account, right? So every time I journalize something, I'm obligated to post it into my ledger. So that means every time I make a transaction, I record it into my ledger and I know how much is going to be in my bank account at all times. Okay, so here it looks just like a journal, except it's got two more additional columns. It's got a debit column and a credit column to reflect the normal balance. Okay, and this is where the terminology of why my cash, which is an asset, has a normal balance of a debit balance. Okay, so you see how things are coming together. There's reasons why they're named after certain things. In this case, every time I start with an account balance, it's always positive on the debit side. I added money, it's still positive on the debit side. I spent money, it's still positive on the debit side. I spent more money, it's still positive on the debit side. However, it's just decreasing. Okay? So in this case, that's how you explain what a normal balance is. And this is going to come into play when we dive into our fictitious business, okay? So once again, I'm not going to test you on the general ledger itself. I just want you to recognize what the difference is between the ledger and the journal. The journal is just the daily transactions. The ledger is the same thing, except it records the account balances. Okay? So again, every time we enter a transaction, you're going to calculate your account balance at all times. So it's always important to, especially when you're dealing with a cash account, you always want to make sure that you have enough cash in your account in order for you to keep spending, right? Okay? That's definitely a rule of thumb. You definitely want to update and keep your cash ledger updated at all times, especially if you're a kind of business that likes to pay all their bills all at one day, right? Oh, it's the 15th of the month, I got to pay all my bills. Okay? Then you want to be very, very careful on all the checks that you write because you want to always make sure that you have enough money in the bank account in order for you to validate those checks that you write. Okay? So here's the course review. Once again, we talked about what the chart of accounts is. We took a look at what a journal looks like, right? It should look like this. The date, the account names, right? The post reference, which is the account number. The debits and the credits should match at all times. Okay? Remember, all debits and all credits must match. The different correcting entries. So once again, we took a look at two. The reverse and re-entry and the error cancellation. Okay? We also got to look at a T account. And again, once again, I'm only going to test you on knowing the difference between the journal and the ledger. The primary core thing that I want you to get away from this class is understanding how the journal works, because that's going to be the primary core of what we're going to be doing for the next 15 weeks. We're going to be practicing journalizing. Okay? So, we will look at the ledger when we dive into the fictitious business. All right? Okay. Any questions in regards to chapter 3?
I have one.
Yes.
You made a statement just a couple minutes ago. did you say that the wait, hold on, let me look at my notes here. Did you say that the general journal is basically like your daily activity?
Correct.
Okay.
Yes, it's your daily activity, right? You record the way you see it, you have your debit and you have your credit. That's it, right? Where your ledger, right, allows you to record those same daily transactions. However, you have a running balance, you know? So for example, right, if I started out with the 5,124, right? I enter my first transaction, which I had sales of $154. So therefore, my account balance has increased, right? I wrote a check for rent for a $500. It decreased my cash account. So in this case, my ledger gives me a running balance in each account that is in the chart of accounts. Whereas the journal just simply records the transaction at hand. Okay?
Okay, quick question, Felipe.
Okay, yes.
So if I bought okay, furniture again, that'll be a credit, not a debit.
If you bought furniture, what is furniture?
Um, an asset.
Right. And if you acquire it, right, aren't you increasing your assets?
But but I let's say I spend the money like pay rent. Oh, I'm sorry, this is where I'm confused.
Okay, good. We're going to practice that in a few. Okay? So because you spent the cash, right? If you acquired the furniture, right? If you just write furniture and you debit it, right? That's a single entry. What is your opposite credit? You spent the cash, right?
Yeah.
So that's why you would credit your cash account.
Okay. Okay.
Okay?
Yeah.
Don't worry. We're going to practice this. Again, the journal is going to be a big portion of everything that you learn throughout the next 15 weeks. That's what we're going to practice. We're going to practice journalizing, journalizing, journalizing. That's all this class is about, is journalizing, because that's what a bookkeeper does. It journalizes everything. Okay? All right, any extra questions? We're running a little short on time here. Okay. All right, so let's go ahead and dive right into the chapter 3 exercises. So once again, let's try to get as far as we can. If I need to ask you guys like maybe 10 or 15 minutes after class, if that's possible, that would be great as well. Okay, so here we are. Number 1, what is the chart of accounts, or what is a chart of accounts?
A list of all the accounts used in the in your general journal.
Good.
Record your transactions.
Perfect. It's a list of all accounts needed to record in a journal. Okay, good. All right. What about question number 2? What is the general journal?
A book where daily business transactions are recorded.
Good. A book where a book to record the daily business transactions. Okay, good. Right. What is the general ledger?
All book of record of all accounts with their respective running account balances.
Good. A book of all accounts with their respective account balances. Okay, good. Number 4, what are the 7 steps of the transaction analysis? Okay, what's step 1?
Collect the source document to prove this transaction happened.
Okay, good. Or also, yes, collect source document for proof of a transaction. Okay, what's step 2?
Understanding the transaction.
Good, right? Understanding the transaction, right? And how, all right, what's step number 3?
Determine what account will be affected.
Determining which accounts will be affected. Okay? What's step 4?
Use the debit and credit rule to determine if the accounts are debited or credited.
Okay, so that's going to be
So
step 5. Yes. So what's step 4? What do you have to do before that?
Charting the accounts.
Yes, you need to check out if the account exists in your business chart of accounts. Right? And then you can go ahead and use the debit/credit system, right? To determine which accounts are increased or which accounts are decreased. Good. What is step 6?
A journal should be used to record the transaction.
Good. Determine which book to record transaction. And lastly, what is step number 7?
Is it just record?
Yes, or in this case, the Nike logo. Do it. Record the transaction. Okay. All right. Number 5. How is the general journal recorded?
Debit. Oh, yes, debit first.
Good. Debits are always first. Good. Debits come first, then credits go last. Okay. How is the general journal recorded, or when is the general journal recorded? Okay. In this case, what goes first? Okay. Wait. Let me see. How is the general journal recorded? Okay. So this one is okay. So in this case, this answer right here is actually down here, right? What goes first? Your debits go first. So in this case, this is kind of asking
With the description, or what?
hold on, let me see. How is the general? Okay, so this one is time sensitive. So that's what this question is asking. In terms of time, right? How is the general journal recorded?
Oh, that would be recorded in chronological order.
Correct. Chronological order. Okay. All right. Where this one now it asks us when recorded a general journal transaction. Okay. What goes first? And that's where debit goes first. Okay. So we switched those answers. I was confused there too, but that's okay. We fixed that. So here we are. It's based on time. So it's going to be chronologically in order, right? By date. Right? At the date as the transaction occurs, you record it right then and there. All right? Where this one is when recorded, the general journal, what comes first? Your debits. Okay? All right, at the end of journalizing, what must be true?
Debits must equal credits.
Yes, debits must equal credits. All right. Number 8. Okay, what are the 2 methods of correcting journals?
Reverse and reentry.
Yes, reverse.
Cancellation.
Good. Reverse and reentry. And cancel and error cancellation. Good. Right. Okay. All right, so here, number 9. This is where I was talking about us practicing how we determine our transaction and how we record it. So let's go ahead and take it here. Here is a chart of accounts that I've provided for you. The left side is going to be the account number. The right side is going to be the associated account for that particular item. And again, it tells you what the account type is, right? It's in order based on account type. So you have your assets first, liabilities, and so on and so forth. Okay, so make sure you understand, and let's practice utilizing the chart of accounts. We're going to practice also utilizing the 7 steps of transaction analysis. So let's go ahead and dive right here in the first one, right? On January 1st, you paid rent for $500 cash. So, does this affect the business?
Yes.
Yes, it does. Okay? Now let's use our chart of accounts. Do we have a cash account?
Yes.
Yes, we do. Do we have rent anywhere?
660, so rent expenses.
Perfect. We have a rent expense. So we determined that we have the accounts that we need. Now let's apply the debit and credit system, right? I paid for rent. Okay? How am I going to record that? If I paid for rent, which account am I going to be debiting?
660.
Yes, your rent expense. That's correct.
Yeah.
Because what did we pay?
We paid rent.
We paid with cash.
I'll pay the cat. Okay. Yeah.
So therefore, we're decreasing the money that we have, right?
Yes.
So therefore, we're going to credit that account. Okay? So now that we've determined our debit and credit system, now let's go ahead and do step number 7. Let's do it. Okay? So, January 1st, we determined that we have a rent expense. Okay? And we determined that we used cash, right? We're going to indent for my credit, right? My post reference is going to be the account number. So again, Felipe said that rent expense was account number 660. What is my cash account number?
100.
100. Good, or 100, okay? Now, let's determine what amount did I pay rent for?
500.
We did it for $500. So that means $500 goes to rent, and I'm gonna debit my cash account by $500 because I've spent that money. All right. It's up to you if you want to use descriptions, but in this case, we're just practicing for now. So I'm not going to put any descriptions for now. All right. We have plenty of time to practice that later on. So in this case, I just want you to understand what accounts are you going to lay down on your foundation. What accounts are you going to use? Okay. So let's see what happens next. So that's a perfect example of the first transaction. We use the transaction analysis. We determined everything, and here we posted it to our journal. Okay. So let's see what happened next. All right. On June 5th, you purchased inventory 100 items for $1 each. Okay. All right. Whoops. I gotta move this over now. So that once we did that, and we paid with cash. All right. So let's look at our chart of accounts one more time. Do we have inventory?
Yes.
Yes, we do. Do we have cash?
Yes.
Yeah.
Yes, we do. Now, if I bought inventory, did I increase my assets or did I decrease my assets?
Increase.
Okay, we purchased inventory.
Increase.
Yes, we increased our inventory, so therefore we increased our assets. So therefore we're going to debit my inventory. Now, how did I pay for it?
With cash.
With cash. So did I increase my cash or did I decrease my cash?
You decreased it.
I spent my cash. So again, it is we're gonna credit my cash account because I spent more money. So in this case, most transactions, this is general rule of thumb as well. If you notice, every transaction it is separated by a line to determine when the next transaction starts and when the next transaction ends. Okay, so here I'm gonna leave a line of space so to determine that my first transaction is separate from my next transaction. So here we are. We determined that inventory is going to be used. Okay. inventory, okay? And we established that we paid it with cash. Okay, so my account number for inventory is
Hello?
yes. What is my inventory account number?
It is 150.
150.
Perfect. 150, and my cash was once again 100. I can look at right above, okay? Now let's go ahead and determine, right? If I made a purchase of 100 items and they were $1 each, how much money did I actually spend?
$100.
You spent $100. So that's exactly what you're going to write right here. You spent $100 to buy $100 worth of inventory. Okay? Good. All right. Let's see what happened next on January 8th. Okay? January 8th, you purchased a machine for $750 cash. All right, let's look at my chart of accounts. Do I have a machine?
You have equipment.
You have equipment because machine is considered equipment, right?
Yes.
Oh, there you go. How did I pay for it?
You paid with cash.
We paid with cash once again. So again, equipment is number 160. So here we're going to determine, let me see what the date was again. Once again, it's the 8th. So here, January 8th, we determined that we bought equipment. Right? We acquired an asset, so therefore we bought something, and we bought it with cash. So again, equipment was account 160, and my cash account was 100. Now, how much was that machine worth?
$750.
$750. So assuming, no sales tax. Okay, $750. Okay, good. All right, let's see what happened next. On January 10, you purchased supplies for $56 on account. Okay, so this is something you're going to see very often. What does it mean if I place something on an account?
That means like a store credit card or
Correct.
Store. Yeah.
Correct. So, is that in any way that I made a payment right then and there?
No.
No. So therefore,
Liability?
it's a liability. Good job. Okay, so let's take a look at our accounts. Do I have an account for supplies?
Yes.
Yes. Okay, now let's check out our liabilities. What do we see that can fit into the category of a liability?
accounts payable.
Accounts payable, right? Because we owe money to a company, right? A vendor, right? And they're not going to let us pay for very long, right? Or owe for them for very long. Usually 30 days. So here we have accounts payable, right? It's definitely not a loan. Okay. So in this case, I have determined my accounts. Now, if I purchase supplies, right? Am I increasing my supplies or am I decreasing it?
You're increasing.
So therefore, it's an asset. So how am I going to increase it?
Debit.
Correct. Now here's the question here. If I'm going to increase a liability, right? Because I owe this company money. Am I increasing my liabilities or am I decreasing my liabilities?
You're increasing your liability
Increasing. And how do we increase a liability?
to credit.
Debit.
With a credit, okay? Because we're increasing liabilities. If you look at your accounting model, it's going to show you that in order to increase a liability, you are going to credit the account. So here I recognize that I have supplies, right? And I also owe them on an account. Okay? Now, how much was my supplies for? How much did I make a purchase of those supplies for?
$6.
$56. Okay, so let me grab these numbers here. So supplies for was 110 and accounts payable is 200. So here, supplies is once again 110, and my accounts payable is 200, and we bought it for $56. Okay. Now, let's see what has happened next. On January 12th, okay, you had cash sales of 25 toys for $5 each, no sales tax. Okay. So here we have a sale, okay, and it was cash sales. So do we have a cash account?
Yes.
Yes. Do we have a sales account?
Yes.
Yes, we do. So in this case, how much cash did I receive from the sales?
$125.
You got $125, right? 25 times 5 is 125. So in this case, am I increasing my cash or am I decreasing my cash?
You're increasing.
Increasing, and I'm going to increase it with a debit, okay? Now let's take a look at my sales. What type of account is my sales account?
Revenue.
Revenue, okay? How do you increase a revenue?
Credit?
You credit the account. Good. So we got cash for 100 and we have sales for 410. All right. So the date was, I believe it was the 12th. We got cash. Okay. For a total of 125, right? We're debiting it because we gain the money. We're increasing our cash, and we're also at the same time increasing our sales for 410. So therefore, $125. Okay. All right. So again, we're almost done here. Okay. So now, once again, on January 12th, you need to adjust inventory for the cost of items sold. So, what is that terminology when we need to cost the items that we sell?
Reverse and reentry.
Not the reverse and reentry, okay? If I need to adjust my inventory, right? And I'm looking at determining the cost of the items I sold.
So it wouldn't be would it be a sell in 410 and a 150 or
Okay, so 150 inventory is correct. It's one of the accounts. Okay?
410.
410, we already recorded the sales.
Oh yeah, that's right.
Okay? So in this case, I'm looking to adjust for the cost of selling the items. All right? So listen to cost of goods sold. And what kind of what kind of account is a cost of goods sold?
no 600?
Oh, what kind of account is it?
It's an expense account.
It's an expense account. So again, this is going to be coming into major play in chapter 5 and chapter 8. So, or chapter 7. So in this case, every time we sell a particular inventory, right, in order to adjust it, we need to expense it. We need to get rid of it, right, because we no longer have it. So in order to do that, we need to utilize a cost of goods sold. Now, if we're increasing our cost of goods sold, right, because we sold the items, right, we need to debit the account, right? Because our equal and opposite is, do we have that inventory anymore?
No.
No, we need to take it out of inventory, right? So therefore, we're going to take this idea and we're going to credit my inventory because I no longer have the inventory item anymore. I sold it, it's gone. I need to get rid of it in my inventory as well. I need to subtract it out of my inventory. So in this case, inventory is 150. Cost of goods sold is 600. Okay? And how I'm going to do that is, of course, I've already explained once again. Most likely, cost of goods sold, since it's an expense, cost of goods sold, most likely you will encounter a cost of goods sold to be an expense, which has a normal balance of a debit balance. So in this case, you will rarely see any expenses that have a credit balance unless it's a contra account. All right. In this case, it's a main account. And let me see. If I sold, right, 25 items, right? How much did it originally cost me?
100. Oh no, wait a minute.
$5. So,
25.
Okay, let's try again. So, if I originally bought my items, I bought 100 items at $1 each.
Yes.
oh,
So, how much did it cost you to buy the items?
$100.
Okay, now that's all 100 items.
Right. No, 25 is the answer you're looking for.
20, right? Because I'm looking at individual level, right? So if it cost me $100 in total to buy 100 items, right? It cost me $1 for each item. So in this case, if I sold 25 of them, how much did it cost me to sell 25 of those items? It cost me $25 because I originally purchased them for $1 each. So in this case, $25 is the correct answer. Good job, guys. I know this is a little advanced, but eventually it will make all sense at the end of this, okay?
I jumped into it. Hey.
No.
No. All of a sudden, math got hard for me.
Again, like I said, don't worry about that. It happens, okay? So last but not least, now we have January 15. You borrowed $5,000 from the bank. Okay, you borrowed $5,000 from the bank. What do you think would
A liability?
it'd be a liability, correct? Now, if you borrowed $5,000 from the bank, what technically did you do?
You got a loan.
You got a loan. Perfect. So we have a loan, $250. All right. Now, if I borrowed $5,000, what am I getting in return?
Credit?
Asset.
I mean,
Would it be
An
cash?
increase
Now
in
you have
money?
more cash?
Yes, we got cash. We borrowed $5,000 from the bank. That means we got cash. So in this case, did we increase our cash or did we decrease our cash? We increased it, so therefore we're going to debit it. Now, the question is, did we increase what we owe or do we decrease what we owe?
We increased what we owe.
We increased it because we borrowed money. That means we owe more people, right? So in this case, it's going to be an increase on what side? How do you increase a liability?
Debit.
How do you
I mean,
increase
a
it?
credit.
Good. You increased it on the credit side. All right, so here we are, January 15. We borrowed money, right? We borrowed $5,000 cash, and we borrowed it by taking out a loan. Okay, so in this case, once again, my account number. So let's look at what my loan is. It is the account number 250, and my cash was 100. Okay, so in 250, and we borrowed it for a grand total of $5,000. Okay, so if I can borrow 10 more minutes of your time.
Can you
Okay,
sit up just a little bit so I could see the cost of goods sold?
you here.
Right there.
Perfect. Okay. So again, this won't come into play until chapter 7. All right.
Quick question.
Yes.
So in my mind, I keep trying to keep like a balance. This is not a balance. This is just a record keeping.
Absolutely.
Okay. All right.
Yeah.
Thank
Yes. Remember, when we keep a record and keep an account balance, what book do we need to use?
A journal.
Which one has the account balances? It'd be your ledger.
Or ledger, I mean, don't
Okay.
you,
Hmm.
So this is the one that we want to add the debits and credits and make sure that they're the same?
Yes, that's correct.
Okay.
So in this case, these are all simplified, simple transactions. Again, I will start testing you for more advanced in chapter 5. So for now, we're just learning the basics. Try to understand the fundamentals or just getting the simple accounts down. All right? Getting you kind of used to journalizing a transaction. Okay? So again, we took the 7 steps of transaction analysis. We look at the scenario. We understood how it affected the business. We understood how to use the chart of accounts, understood how to do the debit and credit system, and we journalized it. So again, this is going to be very good practice. And again, we're doing this for the rest of the class. Okay? All right. So any questions in regards to what we just accomplished today?
no.
Okay. Last but not least, I want to go over this real quick. I don't want you to do this for homework. So let's just try to get it out of the way real quick. So in this case, all right, I'm going to use the transaction on January 10th from above because I realized I made a mistake. Okay, I recorded that the supplies were $56 on an account only on January 20th to realize that it was for the wrong amount, right? We actually purchased it for $65, right? Because I looked at the receipt twice again. I fat fingered that this was 56, not 65. Okay, so now I want to fix this error in my journal, right? This is days later. So if I found out on January 20th, let's go ahead and exercise both different methods. So let's look at the reverse and the re-entry, okay? So if I'm going to find out that on January 20th, if my original was I recorded the supplies for $56 on an account for $56, so let's take a look at it. Here we are. We got a debit to my supplies and a credit to my accounts payable for $56. Now, let's reverse this entry. How do I reverse this entry?
First you list accounts payable.
We're going to list the accounts payable, right? We're going to go, okay, in context, right? I'm going to go back to the store and I'm going to return the item. So I should decrease what I owe, and I'm also going to return my supplies, okay? All right, for the amount of $56, okay? Now I have to re-enter it in. So now I'm going to buy it back. So if I'm going to buy back my entry, what should it be?
Probably will be,
Supplies.
Price.
I'm going to buy back my supplies. And I'm going to, once again, I'm going to owe it on an accounts payable because I'm not paying it yet. I'm paying it later. Okay? And this time, I'm going to journalize it for the correct amount, which is what?
$65.
$65. Okay? So that's how you do the reverse and reentry. Okay? Now, let's do the same thing except in context of the error cancellation. So, if I found out on January 20th, if I look at this, right? Once again, I've journalized that it was supplies for 56, but it's supposed to be 65. So what's my difference here?
$9.
$9, okay? So, let's determine. When I recorded it originally, am I short or am I over in my supplies?
your supplies would be over.
Okay, from
You'd be short because you only got $56.
Oh
this
yeah,
year.
it'd be reversed. It would show shortage.
correct. So in this case, I need to increase my supplies account because I am $9 short in my supplies. So therefore, I'm going to increase it by another $9, right? And therefore, I owe $9 more to the account. Okay? Good job.
I think I have a question.
Yes.
Can you screw up to the reverse and re-entry?
Mm-hmm. Okay. Do you need the scenario too? Oh.
It's because my reverse and re-entry is missing that middle column, so you were really throwing me off.
I'm so sorry. I thought I fixed these things because I fixed it on your end, but I don't know why my stuff is just messed up. It's supposed.
I thought I was looking at a whole different word.
This is supposed. It's supposed to look like that. Sorry. Yeah, I didn't even notice that until now. Yeah. That's what I'm saying. I fixed all of this stuff prior hand, but I don't know why it never saved. So I'm kind of.
Okay, so then we would need to. Would we put the date on that second supplies one too, or just no?
You can. So remember, when we practice the description, right? In this case, I would say to correct the error on January 10. Right? That would be my description here. But again, like I said, I'm not going to be I'm not going to teach you the description like fully yet. We're going to practice doing the descriptions when we go later on into practicing the chapter 5 and chapter 6. So in this case, yes, in this case you should make a note for every time you make an error that when you do correct it, you're going to make sure that you notify that you are doing this to correct the error on January 10th. Okay, which is the transaction on January 10th right here for the supplies. Okay.
Can I see the error and cancellation real quick?
Absolutely. Okay. So once again, I'm going to go ahead and post these answers on the Google Classroom under the same